In this video, we will talk about how to buy your investment rental property for the right price so that you will definitely make a profit. The price you should pay for an investment rental property depends on a variety of factors, including the local real estate market, the condition of the property, the rental income potential, and your investment goals. Generally, you want to look for a property that is priced below market value and has the potential to generate positive cash flow. But in order to properly determine the price at which you should buy a rental property, you should base such price on the property's actual financials and determine its net operating income or NOI. Basically, a property's NOI is the figure you get after you subtract a property's operational expenses from its gross rental income. What is important here is for you to buy the property on the basis of its actual performance of operations and not on the basis of mere potential income. In other words, you should base your purchase price on a property's actual NOI. The benefit of buying a rental property on the basis of its NOI is twofold. First, buying it on the basis of its NOI will most certainly guarantee you a price lower than the market value, and second, you justify such asking price on the basis of the property's numbers. To accurately determine a rental property's income, you need to consider all of the sources of income that the property generates. The primary source of income for a rental property is rent paid by tenants, but there may be other sources of income as well. Here are some steps you can take to determine a rental property's income. 1. Collect information on the property's rental income. Start by collecting information on the property's rental income, including the rent amount, lease terms, and the number of units rented. 2. Factor in additional income. In addition to rent, the property may generate additional income from sources such as parking fees, laundry facilities, storage rentals, or pet fees. Be sure to factor in these additional income sources when calculating the property's income. On the other hand, in determining a rental property's operating expenses, you must take note of all of the costs associated with owning and maintaining the property. Operating expenses can include things like property taxes, insurance, maintenance and repairs, utilities, management fees, and other expenses related to the day-to-day operation of the property. Here are some steps you can take to determine a rental property's operating expenses. 1. Gather all relevant financial documents. Collect all financial documents related to the property, including property tax bills, utility bills, insurance policies, and maintenance and repair invoices. 2. Categorize expenses. Categorize the expenses into different categories, such as property taxes, insurance, maintenance and repairs, utilities, and property management fees. 3. Estimate variable expenses. Some expenses, such as utilities and maintenance, may vary from year to year. Estimate these expenses based on previous year's data or industry averages. 4. Consider capital expenditures. Capital expenditures are significant expenses, such as a new roof or HVAC system, that are not considered operating expenses. However, these expenses should still be factored in when assessing the property's overall profitability. 5. Calculate the total operating expenses. Add up all of the expenses for the property and divide by the number of units to get the average monthly operating expenses per unit. Once you have a rental property's accurate figures regarding income and operating expenses, you can now compute for its NOI by subtracting the operating expenses from its income. For example, if a rental property has an annual NOI of 1 million pesos and has an annual net operating expense of 500,000 pesos, then its NOI is 500,000 pesos. Now, in order to determine the right purchase price of the rental property you plan to buy, it is important for you to know the capitalization rate of comparable properties or properties which are similar to the rental property you are planning on buying. Remember, a property's cap rate can be computed by dividing the property's annual NOI with its selling price. In other words, if you know both the NOI and the trending selling prices for other similar properties, then you can compute for the property's cap rate. For example, if the annual NOI of a similar property is 650,000 pesos and its selling prices is 2 million pesos, then that property's cap rate is 32.5% or 0.325. So, using this similar property's cap rate, you can now compute for the ideal purchase price of the rental property you plan to buy. As mentioned, the property we want to buy has an annual NOI of 500,000 pesos. Now, all we have to do is to divide this figure with 0.325. This will give us an amount of more or less 1,538,461 pesos. Now, this figure is your ideal purchase price, and you should try to buy your rental property on this price, or, if possible, at an even lower price. As mentioned, buying your rental property on the basis of the NOI, or on its actual operational performance, means that you will be buying it at a reasonable and cheaper price, which also means that you will enjoy lesser monthly loan payments. So, there you have it. Hopefully, this video has taught you how to confidently come up or arrive at an offer price for an investment rental property you plan to buy. It is important to know your asking price, since this will serve as the threshold on which you will determine if you will further pursue a deal or move on to the next one. If you have questions or comments, please leave them down below. Thank you for watching, and please don't forget to subscribe.